$517 billion, that's the total unrealized losses sitting on the balance sheets of American banks right now. $500 billion in paper losses that haven't been recognized yet. And in the last 90 days, regional banks have sold more Treasury securities than any quarter since the 2008 financial crisis. Let me show you the exact numbers that just triggered alarm bells at the Federal Reserve. In Q4 2024, regional banks with assets between $10 billion and $250 billion dumped $78 billion in Treasury holdings. In Q1 2025, they sold another $94 billion. That's $172 billion in Treasury liquidations in 6 months. The last time we saw selling at this pace was September 2008, 1 month before Lehman Brothers collapsed. And here's what should terrify you. The banks selling aren't doing it because they want to. They're doing it because they have to. Because their depositors are leaving. Because their commercial real estate loans are imploding. Because the Federal Reserve's emergency lending program just expired and there's no more lifeline. What I'm about to show you is the exact playbook that preceded every major banking crisis in modern history. And the data suggests we're already in the early innings. I'm John A.G. Stay with me. But here's what makes this different from anything we've seen before, and I'll reveal this later in the video. The Treasury market itself is showing stress signals that weren't present in 2008. When banks sell Treasuries, someone has to buy them. And for the first time since the financial crisis, foreign buyers are stepping back at the exact moment domestic sellers are accelerating. China reduced Treasury holdings by $72 billion last year. Japan sold $58 billion. The two largest foreign holders are exiting while American banks are dumping. When you see who's left holding the bag, you'll understand why this banking crisis could trigger something far worse than 2008. Let me explain how banks got into this situation, because understanding the mechanics is critical to seeing what's coming. Banks hold Treasury securities as part of their investment portfolios. In theory, Treasuries are the safest assets in the world. Government-backed, zero default risk. But there's a problem. When interest rates rise, the value of existing bonds falls. It's basic bond math. A Treasury bond paying 1.5% becomes less valuable when new bonds pay 4.5%. Between 2020 and 2022, banks loaded up on long-duration Treasuries when rates were near zero. The Federal Reserve was printing trillions. Yields were at historic lows. Banks bought billions in low-yielding bonds, thinking rates would stay low forever. Then the Fed raised rates at the fastest pace in 40 years, 500 basis points in 16 months. Suddenly, those Treasury portfolios weren't worth what banks paid for them. On paper, the losses were catastrophic. But here's the accounting trick that hid the problem. Banks can classify securities as held to maturity. If they plan to hold the bonds until they mature, they don't have to mark them to market. They don't have to recognize the losses on their income statements. So the losses sat there, hidden, unrealized, until depositors started leaving and banks needed cash. When you need cash, you have to sell, and when you sell, unrealized losses become realized losses. That's what killed Silicon Valley Bank in March 2023. They had $21 billion in unrealized losses. Depositors fled. They had to sell bonds at massive losses. The losses wiped out their capital. Game over. And that same dynamic is now playing out across the entire regional banking sector. Except this time, the Fed's emergency backstop is gone. Welcome to Macro Shield Method. I'm John A.G. If you're new here, hit subscribe and drop a like. This is the banking data that mainstream media isn't covering, honestly. Help me spread it. Now let's get into the current numbers. The FDIC's Q4 2024 quarterly banking profile contains data that should be front page news but isn't. Total unrealized losses on securities held by FDIC-insured banks. $517 billion, down slightly from the peak of $687 billion in Q3 2023, but still more than double any level before 2022. Let me put that in perspective. Total equity capital in the U.S. banking system is approximately $2.4 trillion. Unrealized losses represent 21% of total banking system equity. 1/5 of all bank capital is already effectively gone on paper. And here's the breakdown that matters. The largest banks, those with over $250 billion in assets, hold about $298 billion of those unrealized losses. But they have diverse funding sources, international operations, and systemic importance that guarantees government support. Regional banks, those with $10 billion to $250 billion in assets, hold about $189 billion in unrealized losses. And they have none of the advantages of the big banks. No diverse funding, no implicit government guarantee, no international operations to offset domestic problems. These regional banks are the ones selling. I tracked Treasury transactions reported to the Federal Reserve over the past 2 quarters. Here's what I found. Zions Bank Corporation sold $3.2 billion in Treasury securities in Q4 2024 and took a $156 million loss. KeyCorp sold $4.1 billion and recognized $289 million in losses. Comerica dumped $2.8 billion with $178 million in realized losses. Citizens Financial sold $5.7 billion with losses exceeding 320 million regions. Financial liquidated $3.9 billion in Treasuries with $241 million in losses. These aren't small community banks. These are major regional institutions with hundreds of billions in combined assets. And they're all selling at losses because they have no choice. Why now? 3 converging factors. Factor 1. The Bank Term Funding Program expired in March 2024. This was the Fed's emergency lending facility that let banks borrow against treasuries at par value, ignoring market losses. It was the lifeline that prevented a cascade of failures after Silicon Valley Bank. That lifeline is gone. Banks can no longer paper over their losses by borrowing against underwater bonds at face value. Factor 2. Commercial real estate loans are imploding. Office vacancies hit 19.8% nationally, the highest since the 1980 savings and loan crisis. Regional banks hold approximately $1.8 trillion in commercial real estate loans. Defaults are accelerating. Banks need liquidity to cover loan losses. Factor 3. Deposit outflows continue. Since March 2023, regional banks have lost over $500 billion in deposits to money market funds paying 5%. When deposits leave, banks must shrink their balance sheets. That means selling assets. The math is simple. Deposits leaving plus loans defaulting plus no emergency backstop equals forced Treasury liquidation at losses. And here's the number that shows how severe this has become. The Federal Reserve's H8 data shows that commercial banks reduced their Treasury and agency security holdings by $189 billion in the past 6 months. The only comparable period was late 2008 when banks were desperately raising capital to survive. We're not heading toward a banking crisis. We're already in one. The data proves it. Now let me show you why this extends far beyond regional banks, because what's happening in the Treasury market itself is unprecedented. When banks sell $172 billion in Treasuries in 6 months, someone has to buy them. That buying has traditionally come from 3 sources: the Federal Reserve, foreign central banks, and domestic institutions like pension funds and insurers. The Federal Reserve is no longer buying. They're doing the opposite. Quantitative tightening has removed over $1.5 trillion from the Fed's balance sheet since 2022. They're letting treasuries roll off without reinvesting. Foreign central banks are net sellers. China's treasury holdings dropped from $1.08 trillion in early 2022 to $768 billion today. That's a $312 billion reduction in 3 years. Japan reduced holdings by $117 billion over the same period. The 2 largest foreign creditors are exiting U.S. debt markets, while American banks are forced sellers. So who's buying? Hedge funds. Private equity. Now, I need to be balanced here, because that's what we do on this channel. I'm not predicting that the entire banking system collapses next month. The 2008 comparison has limits. Here are the legitimate counterarguments. First, capital ratios are higher today than in 2008. Banks are required to hold more equity relative to assets. The system is better capitalized on paper. That's true. But capital ratios don't account for unrealized losses. If you adjust equity for mark-to-market losses, capital ratios look much worse. Second, the FDIC Deposit Insurance Fund has $128 billion. That's substantial protection for insured depositors. Also true. But regional bank failures in 2023 cost the fund $35 billion. 3 or 4 more major failures would significantly deplete the fund. And uninsured depositors, those with over $250,000, would still face losses. Third, the Federal Reserve can always restart emergency lending if conditions deteriorate enough. This is probably correct. But emergency intervention has costs: moral hazard, inflation risk, political backlash. The Fed may wait until crisis conditions are undeniable before acting, and by then, significant damage may already be done. The base case isn't systemic collapse. It's a slow-motion consolidation where weaker regional banks fail or merge, the largest banks get larger, and the banking sector becomes even more concentrated. But the tail risk, the scenario where something breaks badly, is higher than at any point since 2008. Let me explain what the worst-case scenario actually looks like. The trigger is a large regional bank failure that creates contagion. Let's call it a $200 billion institution with heavy commercial real estate exposure. Here's how it unfolds. The bank reports a massive quarterly loss due to loan write-offs and security losses. The stock drops 40% in a day. Uninsured depositors, seeing the Silicon Valley Bank playbook, immediately move funds. $30 billion exits in 48 hours. The bank can't meet deposit outflows without selling securities at realized losses. Those losses wipe out remaining equity. The FDIC seizes the bank over a weekend. Now here's where contagion starts. Every other regional bank with similar commercial real estate exposure sees its stock plummet on Monday. Depositors at these banks, rational and self-interested, moved their money to JP Morgan and Bank of America and Wells Fargo. 3 more banks face deposit runs. 1 or 2 fail the following weekend. The FDIC's fund takes another $50 billion hit. Questions emerge about whether the fund can handle more failures. Meanwhile, Treasury markets convulse. Banks forced to sell Treasuries flood the market with supply. Yields spike. Higher yields mean more unrealized losses. The doom loop accelerates. The Fed, facing a choice between letting the crisis burn and restarting emergency programs, chooses intervention. They restart Treasury purchases. They create new lending facilities. But by then, 5 or 6 regional banks have failed. Consumer confidence collapses. Small businesses that banked with regional lenders face payment disruptions. Credit tightens across the economy. Recession follows. This isn't prediction. This is scenario analysis based on historical crisis mechanics. Every element I just described has precedent in 2008, in 1984's continental Illinois, in the 1980s S&L crisis. The difference today is the $517 billion unrealized loss overhang didn't exist in previous crises. It's new, and nobody knows exactly when it breaks. Let me give you the historical parallel that frightens me most. In 1984, Continental Illinois National Bank was the 7th largest bank in America. They had heavy exposure to oil and gas loans that went bad when energy prices crashed. When loan losses mounted, depositors fled. Continental couldn't survive the run. The FDIC and Federal Reserve engineered a bailout that wiped out shareholders but protected depositors. The term too big to fail was literally invented for Continental Illinois. But here's the parallel that applies today. Before Continental failed, there were warning signs for months. Analysts flagged the problem loans. The stock declined steadily. Management reassured investors that everything was fine. Then it wasn't. The actual collapse happened in days. We're seeing the same pattern now. Unrealized losses flagged for 2 years. Stock prices declining. Management reassurances. Analysts warning of commercial real estate exposure. The complacency is identical. Banks have capital buffers. The Fed will intervene. Deposits are insured. That's exactly what people said about Continental Illinois, until they didn't. In 2008, Bear Stearns went from "we have ample liquidity" to collapsed in 72 hours. Lehman Brothers had executives on television the week before bankruptcy saying the firm was sound. Bank failures aren't gradual, they're sudden. The slow decline creates the conditions. The collapse happens fast. And we have all the ingredients today. Unrealized losses, commercial real estate stress, deposit outflows, no emergency backstop. Treasury market illiquidity. The recipe is complete. We're just waiting for someone to light the match. Here's what I think is happening. The banking system is undergoing a fundamental stress test without acknowledging it publicly. Regional banks are quietly liquidating treasuries at losses to survive. The pace of selling matches 2008. But because no major institution has failed yet, the narrative remains, the system is stable. The system is not stable. The FDIC data proves it. The Treasury selling data proves it. The commercial real estate delinquency data proves it. The Federal Reserve knows this. The Treasury Department knows this. That's why they created buyback programs that never existed before. That's why they keep emergency authorities on standby. The question isn't whether we have a banking crisis. We have one. The question is whether it remains contained to periodic regional bank failures or whether it metastasizes into something systemic. And here's what connects this to everything else I cover on this channel. When trust in the banking system erodes, where does capital go? Hard assets. Gold is at record highs. Silver demand is exploding. Physical precious metals premiums are at historic levels. The same forces driving Treasury selling by banks are driving precious metals accumulation by individuals. It's all connected. The monetary system is under stress. The smart money sees it. They're positioning accordingly. This is my analysis, not financial advice. Do your own research. Make your own decisions. But the data is the data. $517 billion in unrealized losses. $172 billion in Treasury sales in 6 months. 66 banks on the FDIC problem list. 312 banks with losses exceeding 50% of equity. Commercial real estate vacancies at 40-year highs. Foreign buyers exiting treasuries. No emergency backstop. Regional banks are selling treasuries at a pace not seen since 2008. The last time this happened, Lehman Brothers collapsed 1 month later. I'm not saying Lehman 2.0 happens tomorrow. I'm saying the conditions that precede major banking crises are present today. And the official narrative of stability doesn't match the underlying data. Drop a comment below. Do you trust your regional bank? Have you moved deposits? Are you positioned for banking stress? I want to hear your strategy. I'll pin the best responses. Share this video with someone who still thinks the banking system is stable. Most people have no idea about the $517 billion in unrealized losses. They don't know regional banks are selling treasuries like it's 2008. Help me spread the data. If you're not subscribed, hit that button now. I'm covering the banking crisis, the silver crisis, and the macro forces that connect them every single day with analysis you won't find anywhere else. I'm John A.G. This is Macro Shield Method. Protect your wealth. Understand the system.